Hi, everybody. Welcome back to Dividend Stockpile, where we talk about all things dividend investing and income investing related. Today, we're continuing our series of interviews with the top talent in the investment world. And today, we have a very special guest. We have Jenny Van Leeuwen Harrington. She is the CEO and portfolio manager of Gilman Hill Asset Management, where she leads the firm's equity income strategy focused on high dividend, low volatility stocks. She has more than 2 decades of experience in finance. And prior, she held roles at Goldman Sachs and Neuberger Berman before joining Gilman Hill. She is a respected voice in the investment community and is a frequent contributor on CNBC. She has her MBA from Columbia Business School and her bachelor's in economics from Hollins University. In addition to all that, she has a brand new book that just came out, Dividend Investing, Dependable Income to Navigate All Market Environments, which I must say is an excellent read, but more on that later. Jenny, welcome to Dividend Stockpile. How's it going today?
Great. Thank you so much for having me, and I'm so happy to be here.
Awesome. Really appreciate it. I love the work that you do. I followed you on X for a while, as well as seen some of your interviews on CNBC, as well as The Compound. So when we got the chance to connect, I was like, absolutely, I have to have Jenny on the channel. Can you give the audience a little bit of a background on yourself and maybe your company?
So we were joking before that I'm long-winded, so I'll try to do this as quickly as possible. But I started my career as an intern in the investment business. And I'll give you one little bit of color, which is I had been working as a cashier at a grocery store, counting money in the drawer. And I thought that was money management. And long story, I was talking to this woman. I had like 3 jobs. I was talking to this woman. I said, "Oh, what does your husband do?" She said, "He's a money manager." I went to, as you mentioned, Hollins, where we had a short-term and J-term program where you could either stay on campus or study. And stay on campus and study or go get an internship. I got an internship and I said, "Oh, I love money management. Do you think your husband would want a free internship this January?" And she went back. She said, "Yes, Harry says you can intern, blah, blah, blah." So I start working in 1994 for Harry Keefe at Keefe Managers. He had been the founder of Keefe, Brett & Woods. So when I was 19 years old, I found portfolio management and I fell in love with this business because I found it to be eternally, infinitely, overwhelmingly interesting. And I loved getting to know about all the big stuff in the world, all the companies and how they worked, how that all interacted. So from age 19, I had my sight set on being a portfolio manager when I grew up. So I went from there to Goldman Sachs to Neuberger Berman. When I was at Neuberger, we had one client call. He said, "I'm 55, I'm getting ready to retire. I need income, but I still need growth. What can you do?" And I transitioned his portfolio to essentially the same portfolio I manage today, the equity income strategy. So the objective was to still have an all stock portfolio, but with an objective of having a 5% or better dividend yield. And because it was all in stocks, it still had potential to grow. So the income grows, the portfolio grows over time. And then that's kind of it. So then in 2006, I left Neuberger. I graduated from Columbia Business School. I left Neuberger. I came here to Gilman Hill. I bought my partners out in 2009. I've been the CEO ever since then. And right now there's 9 of us. We manage about $1 billion. I still manage the equity income strategy pretty much the same way I did in 2001 when I started it with that one guy. And the objective remains to deliver a 5% or better dividend yield with capital appreciation potential on top of that. What I've found over the years is that is a very, very useful strategy. Mm-hmm. It's not playing a game. It's not just trying to beat the market or beat an index. It's giving people who've saved their whole careers money to live off of, or people who have saved and need to supplement their income, or people who've inherited a little bit extra income to make life a little bit easier. So I really love this strategy. There's so much more behind that, but we only have half an hour, not 7 days for me to tell you the whole story. Yeah, but given my personality, I joke the only way I could have been a money manager was managing this, where I just knew that some portion of the return was going to plunk into the account month after month. I need that security.
Yeah, that's what I love about dividend investing is this really is an evergreen strategy. No matter what else is happening in the market, you can always rely on a good quality dividend portfolio. So that's amazing. At 19, when you first started, did you know about dividend investing at that point, or was it a realization at some point?
No, I didn't even know about investing at age 19. Okay. I literally thought money management was counting money in a cash register drawer. and I'm sure if I'd said I'm going to charge $10 an hour as an intern, I wouldn't have gotten hired. I think the only reason I got the job was because I was free. So then I landed Keefe Managers, which was a bank and thrift stock hedge fund, in 1994, right at the height of the bank and thrift stock merger boom. It was such an interesting time. So then I just fell in love with portfolio management. I didn't even know or think about dividend investing until 2001, when this one client called. And it wasn't, I'm going to start something smart, I'm going to do something necessary. It was, hey, this guy needs this. Let's just change his all cap core portfolio to still, all cap core, but with an emphasis on dividend income. In fact, Jeremy, I don't think I really even got the full value of dividend investing until 2009. Okay. So I started in 2001. I left Newberger in 2006, went out on my own, restarted the strategy at Gilman Hill. And then in 2009, when the market was melting down, it was the great financial crisis. Here's the background on this. This is my aha moment, a little late. I think I've always been a late bloomer, by the way. But my aha moment came when I was 9 months pregnant. It was March 5th, 2009. And, and this is actually not dissimilar from this time. What Goldman Sachs trained us to do was, in times of turmoil, communicate. So I was calling my clients over and over again. And like I said, it was March 5th. I gave birth on March 9th at the lows of the market. I was just calling clients. And I called this one client and I said, hey, and by the way, I tell this story in the book. And this is 100% true. And every year when I see this client, we talk about it and kind of laugh about it because, it takes a lot of time to laugh about it. But I was calling every client. And I called this one client and I said, hey, at this point, all bets are off. Market's down 60%. We were down probably close to 40. I said, I don't know what's going to happen from here. I don't know if we'll be down another 10%. It seems like Armageddon. And he said, hey, Jen, is my income safe? And I was like, yeah, your income's fine. And he said, well, then I'm fine. Chill out, go enjoy the rest of your afternoon. And it was in that moment where I really finally fully appreciated the whole value of dividend income investing.
Yeah. I think a lot of people have a similar journey where you're taught or you're told your whole life to do mutual funds or ETFs and just keep investing as much money as you can, let it grow over 20, 30, 40 years. And then when you retire, withdraw all the money and then hopefully die with zero or very little, you utilize all of your money. But the dividend investing strategy is it completely turns that upside down, where you're only taking money from the income you receive, not the principal. So you can still have the principal left over for those big emergencies or for estate planning or charities and things like that. So that's why I turned to dividend investing, because prior to focusing on dividends, I was ETFs and value investor, that type of thing. But then I started having children, and then I realized that I want to be able to provide to them what I didn't have growing up. I grew up lower middle class, if you will. I had to work, all the way through college and high school and stuff like that just to make ends meet. But I'm hoping to give my kids an advantage when they get older. So by focusing on dividends and not selling off the shares in order to fund your lifestyle, it gives them the opportunity to inherit that, as well as myself and my wife to be able to donate to the charities we want in the future, instead of us spending all the resources.
Yeah, that's so nice. I have a very similar, but a little different. Just we financially growing up had a very, very, very rocky childhood, and that high highs and low lows, and that makes me nauseous. And I think when I said before, there's only one kind of investor that I actually could be, the only kind of investor that I could be would be one where some part of that return is very certain and cash is king. And for me, knowing that whether the market's up 20% or down 20%, whether a stock is up 20% or down 20%, the income is just coming to you. That's the only kind of investor that I can be. I think something that I've been needling with is risk management. I'm sure we're always asked the question about risk management. How do you manage risk? Do you use stop losses? Do you use this? What's your portfolio beta? And I've realized the biggest risk, the biggest investment risk a portfolio manager or an individual faces is not from putting a stop loss in place and getting it right or wrong, from behaving badly at the wrong point in time. And one of the things about dividend investing is it really, really, really encourages good investment behavior. So not only does it provide a pragmatic, useful type of portfolio, but when it's, the story I told earlier, when it's March 5th, 2009, or when it's March 20th, 2020, and you're freaking out there's real consequences to selling.
Yeah.
You cut off your income.
Mm-hmm.
So it really forces people to say, well, am I really so scared that I'm going to cut off all my income?
Mm-hmm.
Especially when I know these companies are fine. So the behavioral side is enormously important too. And for me, it's really reassuring. If you're a growth investor, and I'm not dismissing growth investors, like I believe in different strokes for different folks. You need to know what kind of investor you are, do whatever you're going to behave best with. But when you're buying a growth stock, 100% of the return is uncertain. And you need to be right on your story on why earnings are going to grow, why the valuation is going to expand.
Yep.
When you're a dividend income investor, not to be confused with a dividend growth investor. When you're a dividend income investor, some portion of that return is quite certain, presuming you've done your homework and gotten, whether it's the ETF or the individual stock, presuming you've done your homework and gotten that right, some portion of that return should be quite certain. And that is very comforting.
Yeah, I totally agree. That's my focus. Personally, I strive for about a 5% yield on my portfolio, and between 5 and 7% average growth over time. So I'm right in that sweet spot between getting the current income now, but still getting into the growth later. So I think this is actually a good transition. So your focus on your fund is for higher income strategies. So why did you choose that over a dividend growth strategy for your clients?
Well, it all goes back to the fact that I didn't really choose it. It just came to me. It's this one client in 2001, and he literally said, I'm 55. I'm getting ready to retire, but I know I'm too young. So I still need growth, but I also need income. So I really had to focus for him on creating a high income stream. And it was one account. What I didn't know is how many people were in that same boat. And I got lucky to some degree too. That was 2001, and we know what interest rates did for the next 20 plus years. They just went down and down and down.
Yeah.
So something that you and I both know too, that your viewers may or may not, is prior to the .com boom, prior to the late 1990s, the S&P 500 delivered about a 3.5% dividend yield. It's pretty juicy. So you didn't have to actively seek it out. But then during the .com boom, the world got divided into new economy stocks and old economy stocks.
Yep.
Not only old economy stocks would still pay a dividend, and they were shunned. New economy, take all your cash, reinvest it, grow. And with that, the average yield of the S&P 500 shrunk from a long history of 3.5% to 1.5% or less.
Yep.
So starting in the late 90s, you had to go and seek out dividend income. It wasn't just an automatic byproduct of investing in stocks. So I really didn't do it strategically. People go, oh, you're an entrepreneur. That's so great. You're so creative. I'm like, no, I just started one thing and, took the next step and took the next step and took the next step, and kind of took it where it went. But what I found over the years is it's just useful for some people. And I don't think it's so useful for so many people that I would ever manage $100 billion. It is unique. And it's kind of boutique-y and niche. And there are plenty of people out there who are totally comfortable investing for growth and saying, if I need 5%, I'll just sell 5% a year. And to them, that's great. That is fine. And in my book too, I talk about that. I'm like, that is totally valid and fine. It just doesn't work for me. It gives me too much anxiety.
Yep.
If we go to, and then people say, oh, well, aren't you leaving return on the table? Well, you have in the past 5 and 10 years. But by the way, as the Magnificent Seven or the top 10 have sucked up all the air in the room, everything except for the S&P 500 and the NASDAQ and those top 10, have left everything in the dust. If you carve out this, I would say, distorted past 5 to 10 year period and look back to history, it was so interesting. Whether it's high dividend yield, S&P, mid cap, value, international, everything was kind of in the same range.
Yeah.
So barring the distortion of the past few years, you weren't really leaving return on the table. You're just saying, which way do you want it to come? If the market returns 8 to 10% over time, do you want 5% of it from dividend and 3% from growth? Do you want all from growth? Take your pick, whichever way you want. So historically, it wasn't leaving return on the table. And I'm going to bet you that over the next 5 and 10 years, I don't think you're going to be leaving return on the table. I think it's just, pick which flavor you want.
Yeah, and that's exactly my view as well. I think there's going to be a little bit of reversion to the mean when it comes to the long-term histories. And, the value plays and the dividend plays will have a stronger impact over the next few years, especially considering the valuations on some of these big tech names. It's not going to last forever. So it's good to have a variety of future resources, whether it's dividend stocks or ETFs, to balance out maybe your big tech exposure. Going back to your fund, equity income fund, it looks like it's a separately managed account is how you operate it. And what I saw online was about 30 to 40 holdings on average. Can you talk a little bit more about your strategy there?
Sure. So they're all separately managed accounts. Some of our clients who are very self-directed and really act as their own investment advisor, they come directly to us, but most are through investment advisors who hire us to manage their clients' portfolios. And again, they're all separately managed. So when you say fund, it's not even technically a fund, it's a strategy.
Okay.
I like that. I like the idea of everyone's account just being their account. So if they want to pull the plug, you pull the plug tomorrow, your cash is your cash. Your dividends are your dividends going into your account. So that to me was always very intentional. But like I said before, the objective has always been to have a 5% or better dividend yield. The objective has always been to be well diversified by sector and security. So when it started back in 2001, it was about 20% REITs, real estate investment trusts, about 20% master limited partnerships. We'll just call it midstream energy now because a lot of them aren't organized as MLPs. They're just C Corps. So you don't need to deal with those terrible K1s, even though it does make for tax efficiency. And about 10% was utilities.
Okay.
And then the rest was just common stocks that happen to pay a high dividend yield. So fast forward today, those percentages are different. They've shifted over time. Right now, I think we're still about 20% real estate investment trusts. Right now, I think about 13.5%. I call it midstream energy now because they're not all MLPs, but it's all still the pipelines. And I think about 6% in utilities right now. But the rest are common stocks, and they're things like Conagra, Bristol Myers, Verizon, Sixth Street Lending, which is a BDC. I used to be very opposed to BDCs, and that industry has really grown up and really professionalized and become dependable in a way that I don't think it used to be. And Western Union, they're just funky stocks. One of the things that I talk about in the book, which I hope I did a good enough job fleshing this out, but you can even have companies in the same industry that no one would say, oh, well, that's a dividend industry. But you can have companies in the same industry who just are philosophically different. And one might choose to pay a dividend and one might not. So I do a comparison between United Rentals and H&E Equipment. And so, here at Gilman Hill, we also have a disciplined growth strategy that's managed by my partner, Greg. Greg has owned United Rentals for years. It's been incredibly successful. It's just equipment rentals. For a long time, I owned H&E Equipment, which is just equipment rentals. But H&E, way back from the start, had a philosophy of having some significant part of their total return to shareholders be through a dividend. United Rentals, which was started as a roll-up, said, hey, we're going to use our cash flow to acquire and grow that way. So just different kinds of companies. But I think what surprises people a lot are how many different kinds of companies choose to pay a dividend to their clients. So the goal's always been to be a pretty well, within 30 to 40 stocks, to be pretty well diversified. When I was in business school, there was a study by Markowitz that basically showed if you own over 50 stocks, you don't diverge that much from the market return. You can look at that as a blessing and a curse, but I've always thought if you're hiring me to do something unique, then add some value. And I think that 30 to 40 stock range is enough to add functional diversification without adding so much diversification that you might as well just buy the S&P 500 and pay 0.01% in fees or 0.2%.
Yeah, exactly. Yeah, I think a lot of people feel like they need to have 0.5% in 200 different companies to be diversified. But again, if you look at the statistics of it, once you go past that 30 to 40 range, you really don't get much added benefit from those extra names. You're just making it harder for you to keep up with your holdings at that point. Because if you are going to be holding individual securities, you need to be able to do some basic research and keep up with those companies. And once you have 100 different companies, there's no way you can do that, even if it was your full-time job.
Right. And that's the key, even if it was your full-time job. Yeah. I made an analogy once that I'm very proud of, even though I botch the analogy every time I retell it. But I made the analogy, and I'm sure you see this too. People will show us their portfolios and say oh, hey, can you review my portfolio? And so frequently we see those 100, 150, 200, 300 stock portfolios. And you see these orphaned little positions that are 0.03%, 0.02%.
Mm-hmm.
And I made the analogy that it's like a normal person's closet. Where you open the closet, there's just all this stuff in there. And most of it you don't wear. Some of it's been hanging around for 10 or 15 years. If you were a proper stylist, you'd probably open a closet. There'd be like, 5 great pants, 5 great shirts. You'd look fantastic every day because everything was coherent and went together. But I think that's how I think of those portfolios, as just a really messy closet with no coherence and a lot of stuff lurking in the back depths that you haven't paid attention to. And it just takes up space. And you know what, like repurpose it.
Yeah.
Give it to someone who can actually use it.
Absolutely. I mean, it is spring, so maybe you can do some spring cleaning on your portfolio as well and get rid of those out of date stocks in your portfolio that you don't really care about and it's not doing anything for you anymore.
Yeah.
So I want to go ahead and transition to your book, which, as I mentioned at the beginning, is a fantastic book. I really enjoyed reading through it. Can you tell kind of why you wrote the book and who you were targeting?
Yeah. So I wrote the book, I'm a professional dividend investor. Like, who doesn't want to write a book about what they do? So I wanted to do that. The publishers came to me and asked me if I could, and I was really excited. I thought, when else in my entire life is a publisher going to come to me and ask me if I'll write this book? So despite being at a very busy point in life where it wasn't really the best time to write a book, I jumped on that chance. I think the timing of it is pretty amazing. And it was not strategic. I missed at least 3 deadlines. If I hadn't missed 3 deadlines, I'm pretty sure that I would have released this book probably last June. And as the Mag 7 continued to soar to new heights, I'm quite sure it would have completely fallen on deaf ears. So clearly the market gods are smiling on me. But who I wrote it to is really intentional. So as I started writing it, I should say one thing too. I tried to write a white paper or start a book during the pandemic, and it was really like I went back and even reread what I'd started, and it was really white papery and really boring and dry and nerdy and like academic. And so when Harriman House came to me on this, what I did was I ordered as many books from Amazon as I could find on dividend investing. And then I also had my colleague Bridget go on and find every white paper and everything online that she could find. And I found that there was no middle ground. So there was like really wonky, nerdy white papers that you and I love. There was like Jeremy Siegel's Stocks for the Long Run with his fantastic chapters where he carves out returns of dividend stocks all stocks by dividend quintile, and shows you their return over 70-year periods. Like, you and I love that, but I promise you my mom doesn't. And then the dividend books that I found were extremely superficial. Yeah. Like I was shocked actually, because I even thought, I'm like, how am I going to write anything unique? And what I realized is there wasn't anything in the middle. And most of my friends, no, let me rephrase that. All of my friends, all of my clients are very smart, educated, sophisticated people who just happen to not be professional investors. And so I wanted to write a book to that crowd. And so I really wrote the book using a dividend lens to talk about, investing, portfolio management, risk mitigation, behavior, how to choose stocks. But I use the dividend lens because I knew not everyone was actually going to want dividends. So I tried to do it to, and I think I got this right. I hope I did. But I tried to do it to 2 people, like both people who love dividends and wanted to learn about that, and people who just wanted to learn more about investing, but again, told through a dividend lens. It's like the same way you could be like, I like, I don't know, basketball. I'm still going to enjoy reading this book about baseball because it's like really interesting, like coaching and strategy and sports, blah, blah, blah. I hoped that this book would do that. So it's written to both. My daughter takes piano lessons, and I was at her lesson on Sunday, and her piano teacher ordered the book, and she's like, oh my God, it makes total sense to me. Like, this is great. I could read it. I could understand. And then she said, but what should someone like me do with this? And I said, you should ask your investment advisor smarter questions, because now you understand like portfolio structure. You understand stock discipline. You understand all that better. She's not going to go out and create her own dividend income strategy. She doesn't need it. She's worked with the same investment advisor forever. But hopefully she understands the investment process better. And she, in the last section of the book, toggles between clients and their kind of stories and different stocks. And I think when you start to see it through actual clients' eyes, you can do a better job thinking about your own portfolio. And what I'm sure you see this as much as I do, there's so little confidence in, by the client. And they think, oh, I'm dumb. Like, oh, I don't know this. Oh, I missed the class. Like, oh, I never learned that. Like, no, nobody did. Unless you're in our job, you shouldn't know that. So hopefully it's empowering when people read other clients' experiences to know, like, no, I'm not alone. Like, these are normal questions. I should ask my questions. And now I have better questions to ask.
Yeah, that's what I really loved about the book, is because you do go through all the logistics of creating a dividend portfolio and the benefits of dividends. But then you also have multiple stories of clients and different scenarios where, all the different backgrounds of these clients, you can relate with one of them or multiple of them to personalize it a little bit to you. As you said, you can tell them charts and graphs and, definitions of things all day long, but if they don't get it, like internally, what's the point of the book? So I think you did a really good job at breaking down the basics of dividend investing, what to look for, how to research, the checklist, if you will, of what you have to do before you purchase or while you're researching a stock, as well as how to incorporate it into your life and your investing career. So I think you did a really good job. And it's a great read. It's very easy, even for someone who doesn't really like investing. It flows very easily, and it's stuff you can understand pretty well. So I really enjoyed it. And there's not a lot of great dividend books, as you were mentioning. I think there might be 2 that I've read in my entire career that were good before I read yours. So having something dedicated to the dividend investing philosophy, but also being something that's not dry and boring, was a perfect match for me, at least. So hope everyone else enjoys it. Definitely go out there and order a copy of your book. I know you can find it on Amazon, Barnes and Noble. There's a lot of independent, independent booksellers.
Ask your local bookstore.
Exactly. Bookshop.org is a really good one. And so what they do is they connect buyers to all the independent bookstores out there. So by ordering through that website, it actually reaches out to the local bookstores and orders it, as opposed to you buying it from Amazon, something like that. So I felt, the prices are very similar, and you're supporting the local bookstore. So that's a good match as well.
Okay, I'm going to write that down. That's really good to know. Yeah. I was doing a podcast a couple of weeks ago, and I was asked one of the best questions that I think I've ever been asked. And I hadn't been asked it before. Like most questions, you've had some experience with. But she asked me, how do you know what kind of investor you are? And I thought, what an interesting question. How do you get to the bottom of that? And my response was, you need to try out different stuff. And you need to have a lot of conversations. And it's one of the nice things about having an advisor or a professional investor in your life, because just talking about it, does this feel better to you? Does that feel better to you? It gets back to our earlier part of the conversation, which is, if you believe in mean reversion, if you believe that on average stocks return 8 to 10%, not just, 10 stocks, but on average stocks return. It doesn't matter if you're a growth investor or dividend investor, international investor, domestic investor, on average, if you get these returns. But what's important is figuring out that what kind of investor are you? And that's an important question for people to struggle with and toy around with. And I think the earlier you start investing, the better chance you have of figuring out what's right for you. I just thought it was an interesting idea.
No, it's a great idea, because, even in my personal life, my philosophy and my way of investing has changed over time. But, once I identified and realized what dividend investing can do, I was all about it. But prior, it wasn't really something you even thought about, or, didn't think it was an option. But when your eyes are open and you can see how you can receive income for your assets as opposed to selling off your assets, it completely changes your mindset and gives you another approach to investing that you may not have ever known before.
Yeah.
Obviously, you're in the business. You do research on new companies all the time. A lot is changing in the market right now, especially here in 2025, the ups and downs and the volatility and the unknown future. Are there certain industries or sectors that you feel like have, a higher probability of performing well over the next couple of years?
Well, I think insert the word relatively well, because who knows what we're in for.
Sure.
I hate needing to label a sector or an industry. And I'll give you an example of why. One could say, right, look, I think real estate investment trusts should be decent. You could play either side of that. Interest rates come down, it's good for their balance sheets. If we're in an inflationary period, it's good for their rent. They can escalate their rents. So one could say either of those. But I'm going to tell you, I just added Ryman Hospitality Partners properties, to the portfolio, which is technically a hotel real estate investment trust. Stock's down 30% from its high. They own 5 of the 10 largest non-gaming conference centers in the US. A huge portion of their revenues are corporate. They're booked out years in advance. There's big cancellation fees. They have a high visibility and predictability to their earnings. That is a totally different dynamic than the rest of the hotel REITs that they get pumped with. And it's a totally different dynamic than like the data center REITs or the office REITs or the billboard REITs. So that's, this is why I'm an individual stock investor. I can't stand, knowing like, well, there's this and there's that difference. I do like the midstream energy space. Like that might be one of the few broad brushes that I'm more willing to paint with, but I'll give you the if and or but whatever scenario there too, which is there's a lot of the midstream energy players like Enterprise Products, Energy Transfer, Kinder Morgan, Williams, that really are kind of the old school, for the most part, the old school pipelines that transport oil and gas and essentially charge a toll. But then in our portfolio, we also have Kinetic. And Kinetic is a midstream energy player, but they're not really in that pipeline space. They're in compression and storage, and they have a much higher exposure to the commodity prices. So like on the one hand, if we are in a drill baby drill world, or if we're in a world that says, which I think this is probably more like it, that's more realistic and acknowledging, we need energy in every way, shape, and form we can get it for the next 5, 10, 20 years. We need solar, we need wind, we need oil, we need gas, we need nuclear, we need coal, like we need everything. Then the midstream energy space should be very successful. But you have a little snafu like 2 weeks ago where OPEC says, well, there's already the screws to the global economy. Let's add some pressure and increase our output, drop the price of oil by $10 a barrel. And you have the old school midstream like Enterprise and Energy Transfer, and they kind of don't blink. And you have a Kinetic that takes a 25% drop. So this is, I'm always, there's lots of great companies, but sectors and industries, there's too much nuance for me to be comfortable just saying like, oh yeah, buy utilities.
That makes a lot of sense, because even in the same sector, same industry, companies can be completely different on the risk scale, their opportunities going forward. So that makes sense. So I guess I'll rephrase my question. Are there a few companies that you feel like either you're interested in because of evaluation or a quality aspect that might be interesting for people to do some research on?
Yeah, and so those are some of the ones that I've mentioned. Conagra is an interesting one to me. Trades at about 10 times earnings right now, has a 5.5% dividend yield. It's a consumer staple, right? They make food. And the stock was pummeled before any of the trade stuff because people are using GLP-1 drugs for weight loss. RFK Jr. is going to make America healthy again, which clearly that's going to just, end all caloric intake in the US. So the stock got slaughtered, and you can buy it now at a great yield. And even if you look out, earnings growth should be, 3-4% for this foreseeable future. And I look at that. So I thought it was interesting before when you said you look for 5% dividend yield and then 5 to 7% capital appreciation. You're much bolder than I am. I look for a total of 8 to 10%, hoping that 5% on average comes from dividend yield and 3 to 5% comes from capital appreciation. So I look at a Conagra and I'm like, okay, I should get 5.5% dividend yield. And if the share price grows at the rate of earnings, maybe I get another 3 to 4% on top of that. I get over time on average for the next 3 to 5 years, as long as I hold it, I should theoretically have an 8.5 to 9% return. That sounds great to me right now. And by the way, something that we didn't touch on that's super important for your listeners to remember is dividend income is tax advantaged over, over bond income. Not municipal bond income, but taxable bond income. So, at a tax advantaged rate, hoping that sustains, which I think it will. It's a nice return. So Conagra is one. I love this Ryman, love this. I'd owned it before. It popped onto the screen a few months, maybe longer, maybe 4 or 5 months ago. And I did the homework and I said, look, if I can see this at 92, the only way it's going to get to 92 is because the market's going to take it down. The company's not going to do anything wrong, or presuming it's not down to 92 because the company's done something wrong, which it's a superb management team. They shouldn't. If it's at 92, I should buy this stock. And then the market went so bananas, I was able to buy it in the low to mid 80s instead. So you do your homework and you pin your price, but that's a great company that has a 5.5% yield, has about 8% earnings growth expected ahead of it. The biggest risk there is a serious recession. I don't think odds are high for a serious recession. Odds are currently about 60 to 70% that we will have a recession. Then the key is how long, how deep, how broad, what really goes on with that. I think it's well protected, and you can go back to the GFC, the great financial crisis, and you can say, if we went through that, would the dividend be safe? You can say, yes, it would be. So I like that. I like, when you said you listen to the Compound, I gave this one to Josh Brown, and he just hates it. He hates it so much, but Verizon, right? I think and one of the things that Josh and I argue about a lot, and it's fun, is what's the time period? And Josh will say it's done nothing for 30 years, it's done nothing for 10 years. And I'll say, but your starting point is today. What environment are you in today? And today you get to buy Verizon at, what's it at? 9 times earnings with a 6.5% dividend yield on it, and small, 4 or 5% earnings growth ahead. But you add that on, I'll take that return for this environment, because I don't think that the market returns for the next 5 and 10 years what it returned for the past 5 and 10. For the past 5 and 10 years, it returned, I think 18% for the past 5 and 12% for the past 10. It's pulled a lot of growth forward. So you want more? I can go all day on these.
Do 1 or 2 more.
Okay. All right. What's another good one for you? All right. I love this one. Here's another real estate investment trust. Sabra Healthcare. Sabra Healthcare has, I think it's about 380 skilled nursing and retirement homes. It is a fantastic manager, a guy named Rick Matros, who knows his business inside out, who's an operator before he became a CEO and owner of the real estate. It's got a 7.3% yield. It's got low to mid single digit earnings growth ahead. It's paid the dividend for 15 years. 15 years. Yeah. During the pandemic, he reduced it for a couple quarters. And he called, right away. He's like, I am so sorry. There is no certainty. I'm going to need to reduce this dividend, but I will get it back up as soon as I have clarity. And you know what? He did. And you can look to these periods and say, like, hey, this is a great company. America's aging. We're not getting any younger. If there's a terrible recession, maybe more people stay at home. But frankly, it's often more expensive and more difficult to stay at home than to go into a nursing home or retirement community. So like that's a great business for what we're in now. There's no tariff risk on that one.
No.
And then what's another good one for you? I think maybe, why don't I give you Western Union, which is just a weird little, we all know Western Union. And you can all say like, oh, it's so crummy. It's at like the local convenience store and no one's ever behind the counter. But the amount of global remittances is extraordinary. The stock was pummeled on the border and deportations. There's not I don't think there's going to be a huge amount of impact on that. A lot of those remittances are done by people who are here illegally. There's a lot of non-U.S. In fact, I think only 37% of their revenues are U.S. generated. A lot are overseas. I went to Nepal in 2019. One of my colleagues got married, so we went over there, and I was shocked. There are Western Unions everywhere. So you've got a 9.5% yield. Trades at 5 times earnings.
Wow.
Surprisingly well managed.
5%
earnings growth ahead. Like that's decent. And I like that it's down a lot because people freaked out over deportations when there's not really that big an impact. Zero tariff risk, but there could be recession risk, right? If everyone's making less money, maybe they remit less. So then that goes back to how big, how long, how serious do you think a recession is? But I like that one. And they've been great at paying that dividend for 20 years straight.
Yeah, it's amazing. A lot of people, to your point, throw it out saying it's old school and, everyone's using, apps and, immediate payments. But Western Union offers that as well. They have an app that you can send money. So you don't have to go to this convenience store or the grocery store and fill out that, carbon copy form that you see at the Western Union. You can do it on your app. So there's a lot of technological investments going on there. So it's not a bad deal, especially if you're planning on keeping it for, multiple years or multiple decades. A little blip here and there is in the long run, you're still going to be fine. So those are very interesting picks. Hopefully everyone has a chance to go do some research. Again, if you're looking at that higher yield because you need the income or you want the income now, something like that makes a lot of sense. If you still have a lot of time left, you probably want to look at more like the dividend growth, like the Visas and the Microsofts and things like that. But if you need the income now, 5% is a very, very comfortable and realistic amount of dividend income you can get off of your investments if you look for the right ones. Okay, so let's go and wrap up. Jenny, really appreciate you coming on and talking to us about dividend investing as well as your book. Is there anything else you want to say before we end?
No, I think you did an amazing job, Jeremy. It's so fun to be on with a true dividend lover. So thank you so much. Yeah, and with the depth of your knowledge and experience, it's a treat for me. Thank you.
I really appreciate that. Yeah, and I'm all about the dividend investing. I could talk about this stuff all day. So it's really nice to get to talk to someone again in that mindset and in that industry. So I really appreciate your time. Where can people find you if they want to get more information about you or your company?
Just gilmanhill.com.
Okay.
Yeah.
You can reach out there and contact you.
But my Twitter is a mixed bag of useful and not useful and personal, and sure. I don't know.
And that's the way it should be. Okay.
Thank you. That's what I think. My husband disagrees. He's our compliance officer too.
Okay. He's probably sweating every time he sees a notification.
Pretty much. So pretty much the gilmanhill.com website is where it's at. We have a lot of clips up there from media and other information about Gilman Hill. But I'd say overall, the book's probably the best source because I haven't done white papers and there's not great dividend information on the website. It's just a website.
Yeah, got it. I'll make sure to link different ways for people to get your book in the description of the video. All right. Well, Jenny, again, thank you very much. Really appreciate all your insights and knowledge, and best of luck with your new book.
Thank you so much again.
All right. Thanks.